There is a mathematical strategy that works on virtually any financial instrument in the world. If a market moves, you can map its turning points. The strategy requires two strict conditions: high liquidity and zero manipulation. Major market indices, like the Sensex or Nifty, are ideal environments because their sheer volume prevents single entities from easily controlling the price. Established high-volume commodities also work perfectly. Highly liquid assets like gold or silver provide the clean price action this strategy needs. Avoid applying this to small-cap stocks or recent IPOs, where low volume makes manipulation common. We map these markets using GANN levels. These are static, unmoving lines of support and resistance derived purely from mathematics. Once plotted, they stay in place, taking the guesswork out of reading your chart. By relying on permanent mathematical boundaries, you stop reacting to market chaos. You learn to anticipate precise turning points before the price even gets there. The foundation of a GANN level is a natural number multiplied by itself. Our specific rule is that we are looking exclusively for odd numbers to act as our final levels. Squaring 284 gives 80,656. Because this is an even number, we add exactly 1. The final GANN number is 80,657. If the result is naturally odd, like 161 squared giving 25,921, no adjustment is needed. It instantly becomes a valid GANN level. These absolute calculations give you permanent boundaries. The lines do not repaint, shift, or recalculate as time passes. They are structural facts of the chart. Step 1 is to identify the exact current price of your chosen index. You need this anchor point before you open your reference sheet. This split screen shows our pre-calculated cheat sheet next to a trading platform. You will locate the 10 calculated GANN levels immediately above your current price, and the 10 levels immediately below it. You will draw these 20 lines onto a 15-minute chart. Do not try to place them visually. Open the settings of your horizontal line tool and type in the exact numerical coordinates for every single line. We use the 15-minute time frame because it filters out the microscopic noise of the market. It is the absolute safest environment for a beginner to practice this method. Plotting these 20 lines builds a structural cage around the current price action. You now know exactly where the market is mathematically allowed to pivot. Look at this violently swinging pendulum. Whipsawed markets destroy capital quickly. If the price action on your chart is wildly oscillating sideways without a clear direction, you must protect your portfolio by avoiding that instrument entirely. You must follow the unbreakable rule of trend alignment. You will only look for buy setups when the overarching trend is up, and you will only look for sell setups when the trend is down. To verify the trend, zoom out and read the broader sequence of the market. We use Dow theory for this, meaning we look for a clear pattern of higher highs and higher lows for an uptrend, or lower highs and lower lows for a downtrend. A mathematically perfect GANN line will fail if you trade it against the dominant current of the market. The trend dictates the direction. The GANN line dictates the entry. Think of the market as a fast-moving train, and the GANN lines as the stations where it stops. You cannot board the train while it is moving between stations. Price simply touching a GANN line is not a signal. You must wait for a specific candlestick pattern to form directly on the level, like a bullish engulfing. This is a two-candle pattern where a green candle completely covers the previous red candle's body. You must also factor in time decay. On a 15-minute chart, ignore any perfect setups that form after 2 p.m. There is not enough time left in the trading session for the target to be reached. Patience is mandatory. The correct candlestick pattern forming exactly at the GANN level is your only valid ticket to board the train. Getting stopped out by microscopic market noise right before a massive move is the most common failure point for new traders. We prevent this with a mathematical buffer. This schematic outlines our strict 0.03% buffer rule. You do not place your entry exactly at the high of the pattern, and you do not place your stop loss exactly at the low. You apply an exact 0.03% distance to both. You calculate this manually. Multiply the instrument's current high or low price by 0.03% to find the exact absolute point value, and add or subtract that from your trigger levels. Algorithms often hunt for tight liquidity pools resting exactly at the highs and lows of visible patterns. This mathematical buffer keeps your position safe from those artificial spikes. Once you are in the trade, you use the duality risk management strategy. You must always operate with an even number of lots, or a position size that can be cleanly divided in half. Set a 1-to-1 risk-to-reward target. When price hits it, liquidate 50% of your position. Move the stop loss for your remaining 50% to your entry price, securing a break-even state. Hold the remainder until it hits a 1-to-2 ratio or the next GANN level. By securing half your profit and moving your stop loss to your entry, you transform an active position into a completely risk-free opportunity. No trading system wins every time. Stop losses will inevitably be hit. Following the rules for capital protection is non-negotiable if you want to stay in the market. This underlying math works across the board. If you want a dedicated cheat sheet built for specific asset classes like stocks or commodities, drop a comment below. Your long-term survival relies on executing the 0.03% buffer and duality rules. Master the setup, protect your capital, and let the math do the work.